This is the worrying conclusion from a survey of Canadian mortgage holders that many of us are not prepared for even slight increases in interest rates. A Manulife survey asked more than 2,000 Canadian mortgage holders a simple question. Assuming interest rates are higher next time you renew your mortgage, how much could your mortgage payment increase before it would cause you financial difficulty? 1 in 6 say zero. They can't afford a higher mortgage payment than what they're paying now. 1 in 3 say they can't afford a more than 10% jump, meaning nearly half of those polled may be in trouble when interest rates rise. The head of Manulife Bank of Canada says having your payments go up 10% may sound like a lot, but if you have a $200,000 mortgage and interest rates go up 1%, that's a 10% increase in your mortgage payments. Now, that there is some good news. More than half of those polled say they reduced their debt over the past year, suggesting many are getting ready for when interest rates do inevitably rise. Canadians need to take on more debt than ever to buy a house. The latest figures show the average sale price of a home was more than $450,000 in May, and that is a new record high, up 8% from a year before. Will Dunning is the chief economist with the Canadian Association of Accredited Mortgage Professionals. Great to have you with us, Will.
Glad to be here.
So let's start with this picture. It sounds as though, Canadians are paying down some of their debt, but when we talk about this kind of ability to finance mortgage at higher rates, should we be worried when we hear Canadians say they're not really feeling comfortable with their mortgage payments going up at all?
Well, that's a very difficult question to address. And we've also tried to research that question, and we find it's difficult to get people to actually answer the question, what can you really afford? They seem to be telling what they would really like to see. So there are an awful lot of people who we see from the other answers in their survey, they actually have in the past paid more than they're paying now, but they say they can't afford any increase. So probably they're not telling us what they can afford. They just don't want to see their payment rise is what they're telling us.
Yeah, so what we could glean from the survey is that people, they're not sort of getting really realistic and saying, we would eat dinner out less often in order to pay a higher mortgage. What they're saying is if they change nothing, they can't afford it. So I guess your point is we get realistic when the rubber meets the road and we have to make higher payments.
That's right. That's right. We've tried to research that. People don't borrow as much as they're allowed to borrow. Typically, you might be allowed to borrow 32% of your income for a monthly payment, but typically people might pay 25, 26% of their income, allowing themselves room to accommodate a future rise in payments. So the message has been sent home very much over the past 7 or 8 years that interest rates will rise at some point, and consumers have definitely heard that message. They are at the get-go when they negotiate that mortgage. They're preparing themselves for the future when the interest rate will be higher.
Do you think that, Will, we talk about that preparing for that inevitable day. We do expect, and it would be actually a good sign for the economy to see interest rates normalize, get back up to kind of, whatever that would be, 4 or 5% on the overnight rate. Do you think people actually do the math? I mean, do you think they'd be shocked to know that a 1% move in that overnight rate would be a 10% move on a typical mortgage?
No, they're not doing the math in that amount of detail. They're allowing themselves some flexibility in their payments. They know unexpected things will happen to them, including family situations, that the children need something, they need a new car. People are not doing budget analysis line by line and coming up with an exact number they can afford to pay. But they are just being prudent, and they're getting advice from their lender's office as well. Make sure you've got enough room to accommodate what's going to happen to you in the future. That's why we're not seeing many people in difficulty with their mortgages now. It's not just that there are low interest rates, it's that people are allowing themselves flexibility.
Fair enough. One of the problems, of course, that you have when you are a borrower and you're trying to assess what you can do is that, let's be honest, a lot of the people in the process with you have a bit of a conflict position in terms of they really want you to take the mortgage. They want you to buy the house. A lot of them have bonuses tied to selling you a product. So how do you make sure that you're dealing with the facts that are conservative enough to protect you if, say, interest rates do shoot up?
Yeah. Well, we're not going to get into the kinds of difficulties the states had with the incentives were so adverse that it was virtually guaranteed to create a lot of difficulties. We have a very strong rule book in Canada, and we have lenders that are largely large institutions who are very keen to make sure that they're viable for the long term. We also see borrowers that are acting very prudent. We saw, for example, that people are paying off their mortgages as rapidly as they can. Typically, if you borrow for a 25-year amortization, you will pay it off in about 1/3 less than that, so 17 to 18 years. The benefit of that when interest rates start to rise is you've actually built in some room already to accommodate a future payment increase. You could just return to your original amortization, and that will in itself allow you to deal with a higher payment.
We talked about the value of homes hitting this new record high in May on an average basis. Can you give me your perspective on, does that suggest that can you say that means we're overvalued? Does it suggest that it's just a robust market being driven by, lots of demand out there? How do you read those numbers?
Well, I could talk about that all day. You probably don't want me to. There are a few points I'd like to make. First of all, we have the interest rates have recently fallen to the lowest level ever. So it's not surprising that we're seeing very strong numbers coming out of the housing market. Typically what we see is when interest rates fall, a lot of consumers respond and we see a wave of home buying activity. We're right now in the middle of a very strong wave because we have record low interest rates. That wave will at some point start to abate and we'll see more moderate rates of activity. The second point is that not all areas of Canada are the same. We have two exceptionally strong markets, Vancouver and Toronto, where prices are rising really rapidly, and many other areas in the country where prices are not particularly rising very much, and activity is not really especially strong. If we look at those two segments of the market, we see one that's exceptionally hot, overheated, and we see an awful lot of Canada where there's a lot of calm in the housing market today.
So do we need to worry about the overheated markets upsetting the economy generally? Because the housing really does remain one of the really strong parts of our economy, including all the spillover industries that are affected when people buy a house.
The biggest risk in the housing market probably today is what's going to happen in the broader economy. And of course, there's a lot of uncertainty there. We don't know for sure what's going to be the impact of a lower price of oil. If we see job creation and even moderate rates of increase in interest rates will be tolerable. The question is, are we going to see more job creation over the coming year or two, or are we going to see less job creation over the coming year or two? That probably is the key factor that's going to determine where the market goes and what the risk is in the housing market. If people start losing their jobs, then we rapidly see people having difficulty with their payments. That, to me, in this market, in this time, is the really big issue rather than interest rates.
All right. Well, we got to leave it there. We appreciate your time today.
Thank you very much for having me.
Will Dunning is Chief Economist with the Canadian Association of Accredited Mortgage Professionals.